Here's a number that might shock you. Less than 3% of the world's population is financially free. Not wealthy, financially free, meaning their money works harder than they do. The difference between that 3% and everyone else is not income. It is not luck. It is not even education. It is a system. One specific financial system that separates people who build wealth from people who simply move money from one hand to the other. The 25-15-50-10 rule. A 4-bucket allocation framework that anyone can apply, regardless of income, starting with their very next paycheck. Over the next 10 minutes, we are going to break down every single component of this framework, the verified math behind it, the tax advantages available to you in 2026, and the exact steps to implement it today. MacroPulseBusiness, business and economy intelligence simplified. The 25-15-50-10 rule operates on a simple but powerful principle. Before you spend a single dollar on anything, you divide every paycheck into 4 predetermined automated allocations. 25% to growth, investments that build your wealth over time. 15% to stability, a protective buffer against life's inevitable financial disruptions. 50% to essentials, what you genuinely need to live and function. And 10% to joy, guilt-free spending that makes the entire system sustainable long-term. Most people reverse this sequence. They pay their expenses first, spend freely on wants, and save whatever remains, which is typically nothing. The wealthy pay themselves first, automatically on payday, before the money ever touches their checking account. This system is not about earning more. It is about engineering the flow of what you already earn so that your net financial position improves with every single paycheck, without exception. The first bucket, 25% of every paycheck, is your growth allocation. This is your wealth-building engine. By growth, we mean acquiring assets, things that increase in value over time and generate income independently of your daily labor. Financial assets are the most accessible starting point. Index funds tracking the S&P 500 have returned an average of 10% annually over the last 100 years. This figure is verified across multiple independent financial datasets. Tax-advantaged account wrappers amplify this further. In the United States, the Roth IRA allows completely tax-free growth with a 2026 contribution limit of $75,000 per year, as confirmed by the IRS in Notice IR 2025-111. The 401k allows up to $24,500 annually and often comes with employer matching contributions, which represents free capital that never shows up in any calculation of your salary. To understand the real power of the growth bucket, consider this mathematically verified scenario. Billy starts investing $200 per month at age 20. Phil starts investing $300 per month at age 30. Both stop at 60. Billy invests for 40 years and contributes a total of $96,000. Phil invests for 30 years and contributes $108,000, $12,000 more than Billy. Now apply the verified 100-year, 100-plus year S&P 500 average annual return of 10%. Billy's portfolio compounds to $1,264,816. Phil's portfolio reaches $678,146. Phil contributed more money per month for fewer years and ends up with $586,670 less. The single differentiating variable is a 10-year head start. This is the power of compound interest and the definitive mathematical proof that time is the most valuable financial asset in existence. You cannot purchase it retroactively. Within your growth bucket, your investment options sit on a risk-reward scale. At the lower end are index funds. You are not picking individual stocks or timing the market. You are buying a proportional slice of the entire market in a single instrument. The S&P 500, for example, holds positions in Apple, Microsoft, Amazon, and 497 additional companies simultaneously. You automate monthly contributions and let compounding run. In the middle of the scale is real estate. You can invest directly in rental property or through real estate investment trusts, REITs, which allow participation in commercial real estate portfolios without purchasing physical property. At the higher risk end are skills, a marketable skill. Sales, coding, copywriting, financial modeling can produce returns that no index fund can match in the short term. Unlike a stock position, no market downturn can reduce a skill's value to zero, but it requires significant time to develop before generating returns. The account structure you use for your growth investments matters as much as the investments themselves. For U.S. investors, the Roth IRA is one of the most powerful legal wealth-building tools available. You contribute after-tax dollars, a maximum of $7,500 per year in 2026 for individuals under 50, and every dollar of growth is permanently tax-free. At retirement, all withdrawals carry zero federal tax liability. Peter Thiel, co-founder of PayPal, is reported by ProPublica to have grown his Roth IRA from approximately $2,000 to over $5 billion by investing in pre-IPO equity in PayPal and Facebook. The 401k allows pre-tax contributions of up to $24,500 annually. If your employer matches any percentage of contributions, capture the full match immediately. It represents a 100% return on that capital before a single market trade occurs. In the United Kingdom, the Stocks and Shares ISA allows up to £20,000 annually in fully tax-free growth. The second bucket, 15% of every paycheck, is your stability allocation. This is the most consistently underestimated component of any personal finance system. Most financial frameworks focus exclusively on wealth building and overlook the fragility problem entirely. One unexpected event, a job loss, a medical emergency, a major repair, and without a dedicated stability fund, you are forced to liquidate investments at potentially the worst possible moment, permanently damaging the compounding trajectory of your growth bucket. Your stability fund must meet 3 non-negotiable criteria. First, immediate liquidity with 0 penalties for access. Second, 0 market exposure. Your stability capital must never be subject to equity volatility. Third, it must earn interest while parked. High-yield savings accounts in May 2026 are offering between 4 and 5.5% annual percentage yield, fully FDIC insured. Your target is 5 months of genuine essential expenses held in a dedicated account, completely separate from your growth and joy accounts. The third bucket, 50% of every paycheck, is your essentials allocation. And this is where most people deceive themselves. The word essential has a precise meaning, the non-negotiable baseline costs required to live and function. Housing, groceries, utilities, basic transportation, insurance, and fundamental healthcare. Everything beyond that baseline is discretionary spending, regardless of how habitual or comfortable it feels. The 50% cap functions as a forcing mechanism. If your genuine essential costs consistently exceed 50% of your net income, you have a structural cost of living problem that requires a concrete solution, either increasing income or reducing fixed costs. To protect this allocation, apply the 7-day rule before every non-essential purchase. Wait 7 full days. Most impulse desires dissolve within 48 hours. If after 7 days the purchase genuinely improves your quality of life, not your social image, then make the purchase deliberately and consciously. Sustainable wealth is not built through willpower. It is built through systems that make the right choice the default choice. The fourth and final bucket, 10% of every paycheck, is your joy allocation. This is not optional. It is not a reward. It is a structural component of a sustainable, long-term financial system. The behavioral science on this is clear. Rigid financial deprivation produces short-term compliance and long-term failure. People who eliminate all discretionary spending from their financial plans are statistically more likely to abandon the entire framework within 6 months. The Joy Bucket solves the sustainability problem by design. Open a dedicated Joy account. Automate exactly 10% of your income into it on payday. Use it freely for experiences, entertainment, relationships, and anything that genuinely enriches your life. When the account reaches 0, you wait for the next paycheck. You do not borrow from growth. You do not borrow from stability. You simply wait. This boundary is not a punishment. It is the mechanism that preserves the integrity of your entire financial system indefinitely. The complete system works because it removes daily financial decisions from the equation entirely. On payday, automation distributes your income across all 4 buckets simultaneously before you can see it, touch it, or spend it. 25% to growth, Roth IRA, 401k, and index funds working in the background. 15% to stability, a high-yield savings account earning between 4 and 5% annually. 50% to essentials, covering your genuine, non-negotiable life requirements. 10% to joy, guilt-free, pre-approved, and hard-capped. Implementation takes 1 afternoon. Step 1, calculate your 4 bucket amounts based on your current take-home pay. Step 2, open dedicated accounts for growth and stability if you haven't already. Step 3, schedule automated transfers on payday for all 4 buckets. Set it once. The only remaining variable is time, and the data proves unambiguously that starting today is worth more than contributing more tomorrow. MacroPulseBusiness, business and economy intelligence, simplified. This content is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional for guidance specific to your situation.